this is the risk reward that people don't understand. If you've got a time horizon, let's say the average drawdown in the S&P during a bear market is 25%.
A drawdown being a drop.
Crash.
A lot, yeah, a drop in prices. You're getting compensated 15% a year returns for that at best. In Bitcoin, the average drawdown over the same period will be about 70%, but you're getting 150% return.
If you're on the winning side, though. If I buy it and I can sell it for a higher price.
Just hold it.
That's the key.
All of these are in a nice trend channel. They go up. So anybody can buy something and hold it long enough, it'll go up.
Well, let's look at housing. You can say the same thing about housing. 2008, housing crashed. Just hold it. I have too much debt. I'm underwater. My bank's taking it from me. People are buying Bitcoin with debt.
Yeah, I mean, that would
2020.
I would not recommend that. But housing's different because you can endlessly create more housing. And we have a demographic problem in housing that makes it more complicated. Demographic problem is, A, everyone's leaving the cities now. B, the generational gap. Nobody can afford the boomer houses. We don't have enough cheap housing for young people. People are relocating, moving around. So we've got a very interesting mismatch in real estate now that makes it more complicated than it used to.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge.
Raoul Pal dives into crypto's future, Bitcoin speculation, and stocks versus crypto. Let's uncover what really matters together. Watch now.
Imagine how difficult to replicate what you've achieved in your amazing career is for the average person listening to this versus buying one thing in your Coinbase account, your Robinhood account, and doing nothing. It's there's no cost. It's not like buying a house. It's not like servicing all the stuff. There's no debt involved. There's nothing.
In theory, but theory isn't reality. How many people end up losing money when things go down? How many people panic, especially with Bitcoin? Because if we look at especially the early adopters of Bitcoin, who are those people? These are the people that, well, a lot of the average person is, I want to get rich. I want to get rich quick. It's, I want to make money fast. Versus the average person who's buying the S&P 500, this is somebody who is, I want to invest and build wealth for the long term. It's a very different mindset.
If the average investor of this is 32 years old, and we said, no, you need to invest for the long run, they're never going to have a house. So their whole vision of their future selves is utterly destroyed.
But look, you said
so it becomes
Bitcoin,
a logical thing to actually take more risk. It's logical for them because they've got nothing to lose.
So Bitcoin, you're saying, is 145% a year.
Yeah, and in recent years, as the trend rate of adoption grows, it's probably down to about 100% a year. Let's call it that for easy maths.
But now let's think about this just from a practical long-term perspective. Warren Buffett is arguably the best investor in the history of time. He has averaged about 19% a year over the course of his decades, making him a multi-billionaire. And so when we compare a 20% return from one of the top investors in the world versus, hey, Bitcoin is going to give you 100% a year, there's some sense of
doing
something could be wrong.
nothing. So even if I'm wrong by 50%, you still outperform Buffett. To put it in perspective, Bitcoin since 2010 has done, I think it's about 90 million % returns. There's no asset in all human history that's ever generated as much wealth in the shortest period of time. And because it's not a random thing, it's actually a technology, and it's a network model of technology. As more people use the network, and we see with Bitcoin, governments buying it and asset management firms buying it, everybody else, you have this network adoption model. And so what it creates is the same chart as Google or Amazon, all of these. It just goes up in a log trend over time with some volatility. So you've got a secular bull market, which means that over time prices go up for measurable, understandable reasons. And it happens to be the highest performing asset of all time.
There's one problem.
And it's volatile. The psychological thing you're dead right about. It's very hard when it falls 70%.
Mm-hmm.
I've gone through 3 of those. They're hard.
Ethereum's price trajectory is tightly linked to the Federal Reserve's interest rate outlook, and traders are already anticipating a dovish shift. with markets assigning a 96% probability to a rate cut this week and expecting more easing later in the year. Ether's resilience above key technical levels suggests that momentum could soon swing back in favor of the bulls. Despite a recent 5.73% decline from highs near $4,766, ETH continues to defend its 20-day EMA around $4,450, a sign that buyers are still in control of the broader uptrend. Technically, Ether's consolidating in a bull pennant pattern, a classic continuation setup that typically precedes another strong upward move. If price action confirms a breakout above the pennant's upper boundary, projections point toward $6,750 by October, representing a potential 45% rally from current levels. Analysts highlight that any dips toward the 4,100 to 4,300 zone are likely to attract strong buying interest, reinforcing Ethereum's bullish structure. As long as ETH holds above the golden pocket and key moving averages, the path of least resistance appears higher. Combined with Fed-driven liquidity tailwinds, Ethereum could be on the verge of testing fresh all-time highs in the months ahead.
Oh yeah, you do NASDAQ.
So NASDAQ compounds at 18% a year.
What is NASDAQ?
The NASDAQ is the NASDAQ 100, which is the top technology stocks in the United States. Right? We live in a world that tomorrow will be more digital than today, guaranteed. And so therefore, these stocks tend to generate the most performance. And we've talked about many of these names. That is all in the NASDAQ. So a little arbitrage is if you want to shorten your 7.8 years to 5.5 years, 6 years, buy the NASDAQ 100. It's an ETF.
Yeah.
Zero cost, easy. And then I would say, and then do 70% that, 30% crypto, and you don't have to care about anything.
Sure.
You're fine. Now, if you have a different risk tolerance, you can tweak those dials. Or if you are more risk averse, then you up your cash dial or some other more stable flow, whether it's gold. Although gold is still driven by debasement of currency. They're all the same thing. They're all driven by the same macro factors. But so yeah, similar kind of idea. All you have to do is dollar cost average.
What's that?
So dollar cost averaging is if you're young and you've got a bit of excess cash now, you've sold your income a little bit, as opposed to just chucking everything in. Or you put your large sum in, you've saved up your 10 grand, but now you've got maybe $500 a month of free capital you want to put into your savings. So when you have these drawdowns, you're actually keep buying. And what happens is it lowers your average cost over time and you get to new all-time highs in your portfolio much before the market did. So for example, in the last crypto down cycle in 22, all I did was add as much as I could to my crypto. So I was at new all-time highs in my portfolio well before the market was because I'd lowered my average entry. That compounds your profits over time incredibly.
And is there something psychological there where if you commit to the habit of just putting $500 in regardless of what happens,
you remove emotion.
You remove a bit of emotion from it.
And the emotion is the thing that people struggle with. If you're investing in things that are more volatile, you firstly understand that you will see larger drawdowns when markets go down. Usually they're all correlated. They all go down at the same time, all up at the same time. So you're going to do that. But if you tell yourself, that's an advantage for me because I can buy more, that's a secret hack that makes people fortunes. Compounding. This is Warren Buffett's thing.
I 100% agree with that.
More companies in a bear market than in a bull market because...
I agree. I will 100% agree with that part. I call it poop. Panic leads to overselling, leads to opportunity, leads to profit. So I am on board with that.
The search for passive income has expanded beyond traditional assets in 2025, with yield-bearing stablecoins emerging as a new option for investors seeking steady returns on-chain. Unlike conventional stablecoins such as USDT or USDC, which simply track the dollar, these tokens are designed to generate income from underlying assets or strategies, allowing holders to earn yield while keeping funds liquid in their wallets. Depending on the model, the yield may come from tokenized treasuries, DeFi savings mechanisms, or synthetic structures linked to crypto markets. Tokenized treasury-backed coins mirror traditional cash equivalents by distributing returns from short-term government debt, while DeFi wrappers like SDAI grow balances at rates determined by protocol governance. More experimental synthetic stablecoins, such as SUSDE, generate yield from derivatives and funding rates, offering higher but more volatile returns. However, access varies. US and EU laws now ban issuers from paying direct yield to retail holders, meaning many of these products remain restricted to offshore or institutional markets. Beyond regulation, taxation also complicates adoption. Rebases and rewards are treated as income when received, while eventual disposals trigger capital gains tax. Add in risks from contracts, liquidity, and governance, and it's clear that yield-bearing stablecoins, while promising, demand careful strategy rather than blind adoption. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to BitcoinZella for daily news all for free. That's all for today's video. Until next time.